What's up, guys? Welcome back to the Dynamis podcast market update. Before we dive in, here's what we're breaking down today. So, first and foremost, what's happening in the Strait of Hormuz and why it matters for oil, inflation, and global markets. We're going to talk about Trump's strategy, what I'd call the blockade of the blockade, and how that's shaping geopolitical risks. We're going to talk about why stocks pulled back after all-time highs and what's next, a deep dive into mortgage bonds, rate volatility, and why the housing market is quietly stabilizing, what the Fed is thinking right now, including this idea that AI could actually justify rate cuts. Throughout the whole thing, I'm going to be flipping it back and forth to Bromley to weigh in from a wealth advisor perspective, how he's thinking about risk, allocation, and positioning right now. And this week, guys, it's not data driving markets, it's actually geopolitics. So let's get into it. And with that, Bromley, welcome back this week, my man.
Good to be here with y'all. A lot to talk
Yes.
about for sure.
Yeah, a lot to talk about, a lot going on. Yeah, let's just roll right into it with the we're going to do a accelerated episode this week. We're going to experiment with a 30-minute just condensed version of what's going on, see if we can just squeeze the most out of it. And so we're going to roll right into it this week. We're going to start with the macro theme, and that is the Strait of Hormuz and the controlled chaos. So oil is higher this morning, and it all ties back to rising tensions around the Strait of Hormuz. So just for your guys' information, about 20% of global oil flows through that corridor. Here's what's gone on. Last week, Iran said that they were going to reopen the strait. Then there was ceasefire optimism in the region. Over the weekend following, however, Iran promptly closed the strait down again. They blamed U.S. naval activity. The U.S. seized an Iranian cargo ship, and then Iran started signaling towards retaliation. And what we're seeing right now is what I'd call a blockade of the blockade. So the U.S. is maintaining pressure inside the strait without fully escalating, keeping Iran sort of boxed up and not resolved. So that creates uncertainty. And from that uncertainty, the market reacts, right? We always talk about this concept, Bromley, of market reacts to sentiment more than, action sometimes. So the market's reaction to that was that stocks pulled back, oil went right back up, stocks hit all-time highs on Friday, and then the pullback, they pulled back to start this week. So oil is now moving higher again. Bonds are slightly weaker, but holding, and everything kind of hinges on this ceasefire expiration, which is tomorrow. I'm going to interject here and talk about what I'm doing currently right now. And that is, you and I, Bromley, we've talked about strategy for locking interest rates, right? Like if we're achieving what we want to achieve, sometimes we pull the chips off the table and we err on the side of being conservative. That's exactly what I'm doing right now. We've seen so much forward momentum this last week with interest rates kind of making forward progress again. We saw fuel start to come down. It's crazy. Fuel came down in literally over a 2-day period, fuel came down almost $1 a gallon where I live. And here we are. The ceasefire is going to expire tomorrow. People don't really know what to do. And I personally don't want to gamble on the market. And I'm seeing a lot of room for the downside. And so what I went and did today, Bromley, on my end is I locked all my clients today because, we just have no idea. I can almost guarantee you that we're not going to have, an explosion of a drop of interest rates. There's more risk on them going back up with the ceasefire expiring. So I locked. That's what I did personally. And I'm, that's me erring on the conservative side.
Well, I think it's smart, and to an extent, right? Like when you have a 30, 60-day window to close on a loan, like you're planning for short term, and these short term fluctuations can literally take a deal away, right? So it's wildly important. I do get the benefit of, I tell all my clients, I'm not trying to time the market. Is way more of a time in the market strategy. And on the short run, if you need money, right, for something that you need this month, as an example, then yeah, if the situation looks better than it did yesterday, let's take the chips off the table. Let's, hedge to the downside. But for the most part, you know, that logic that I just explained of looking to the long term, not worrying about the short term noise, even when it is a major conflict or war, has paid off. I mean, the S&P at one point this year was down 8%, and now it's up almost three and a quarter year to date. So just by being patient, you've benefited because if you didn't sell before it dropped that 8% and then got back in before it started going up again, you got to get both sides of that trade right to win if you're trying to time the markets. Typically better to be long if your horizon is long. And I think that's just a very interesting juxtaposition between kind of what you're doing on the day to day in your business and what I'm doing on the day to day for the most part.
Yeah, and not to interject like my own personal investing strategy here into, you
You know,
know, I
I
guess
guess
the
the
geopolitical commentary or even, what you're seeing in the market, but it just reminded me what you're saying just now reminded me is like you and I have so many real estate heavy investor friends. And, the older I get, the more I see the value in diversification. And we can talk about pros and cons of that. We can argue about that. But I think you and I are both fairly in alignment about I guess, the strength and the versatility of having both, stocks and real estate, the diversification. Sometimes real estate's up, sometimes stocks are up, and it kind of pulls each other. Now, the counter to that argument is that we're leaving money on the table and we need to go all in on one thing. But the older I get, the more I like the diversification. And I was talking to this guy last week. We went on this trip and, we were, as Go Bros often do, we talk about our net worth, our portfolio, how we're structured, because why? Iron sharpens iron, right? We're exercising, I guess, we're sparring about what's the best path forward. And sometimes somebody new into your situation can see your blind spots. And so I had made a comment about the amount of stocks that we hold. And of course, I won't say it publicly on air, but you're privy, Bromley, to my stock position. And they made the comment to me of like, okay, hypothetically, because we were talking about what does the future look like for me to grow my business and go all in. Hypothetically, if you sold all that stock and put it into something else, right? Scenario X, you could realistically harvest, 10 to 16K a month from that, right? And I'm like, yeah, hypothetically, I guess I see what you're saying, blah, blah, blah. But at the end of it, I was like, look, it doesn't make any sense for me to sell this portfolio. And here's why. And this is, I guess what I want to say here is that if you and I weren't having these weekly conversations, bi-weekly conversations, this wouldn't even be a thought in my mind. But you and I went for a hike a couple weeks ago. And it occurred to me that you mentioned something that over a certain, once you have a certain position in stocks, you could take lines of credit out against it.
Mhm.
And quite often, those lines of credit are more competitive than the market interest rates. And then I thought about this article I read about how rich people never sell anything, they just borrow against it into perpetuity. And it's not just specific to real estate, it's also stocks. And so I interjected and said, why would I sell? Because here's the tax that's going to be harvested.
Mhm.
It's a position of strength. It balances me in times of uncertainty. I could take a line of credit against it and still put it to work in the same way. I'm not going to pay tax because it's going to continue to grow. I'm paying that debt back. And all that to say is like your point just now. I don't know what it was about your comment, but it just sparked this conversation, this memory of this conversation. And I'm really grateful for us having these conversations because now that's a tool in my toolbox that I'm aware of that I wouldn't have even had prior if it wasn't for you and I having these conversations. And that's exactly the value of this conversation, this relationship, this network.
Well, appreciate it. And happy to be that guy for you. And, it goes both ways. So, yeah, that's exactly why we do it. And that's how you sharpen iron with iron, right? You have a conversation.
Yeah.
That's where authenticity and being open to criticism, right? Constructive or not, is when you share where you're at with somebody that's on a parallel course or ahead of you, you might get beaten up a little bit, or they'll open your eyes to something and you get that unlock. I mean, that's my favorite part of the work that I do with my clients is understanding their goals when they're trying to get there, modeling how they're currently allocating capital towards those goals, and then finding like, wait a minute, if you knew what I knew, you wouldn't be doing it this way. You'd be doing it this way. And then the aha moments and just like, my favorite thing is in
Exactly.
a meeting when I'm like, oh, man, this is exactly what I'd be doing in your situation. And I know they don't know the strategy. And afterwards, I'm like, yeah, I just delivered massive value. That was cool. That felt good.
Well, it's
That felt
funny.
good.
It's funny because when I push back, prior to us having this conversation, I probably wouldn't have even had the tools or the understanding to, counter right? I would have just been like, oh my gosh, you're right. I need to sell all that and put it in here. And it was like a higher risk thing, but something I'm familiar with. Like, the example in this, was like, oh, go put it in private money. Why? I do private money. I'm familiar with private money. You can make 10 to 13% in private money. But if I hadn't had that conversation with you, I wouldn't have even known that tool is available. And it's funny because I made the counter to that statement and I saw the light bulb above his head go on like, oh, I hadn't thought of that. Why sell when you could keep it and take a line of credit? So anyways, just super helpful.
And then the
Let's
20% tax bracket, right? All those unrealized gains, you're kind of discounting the whole pot. Now you've got the whole pot, you can work with it, right? And you have the safety of like you've got a bigger if you sell it, it's gone, like you said. Now it's a bigger balance with a line against it, which creates liquidity to do this parallel investment, which will spit off cash flow that can cover its interest. That interest can be considered an expense for the new business. It's just way more tax efficient.
Yeah, absolutely. Absolutely. All right, let's keep on track here for our condensed
Yes.
biweekly market update. So let's talk about the Fed's narrative towards the shift of AI and rate cuts. You've been tracking this at all? You've been paying attention to what the Fed's been saying on this? So there's a narrative building that AI could increase productivity and reduce inflation, giving the Fed room to cut rates. But
Yeah, I mean, that's
inflation.
huge. I was gonna say, in general, technology is deflationary. So part of the reason we haven't, if you think about it, like since the dawn of the dot-com era, we've had massive productivity and technology gains, and we've corresponded that with massive amounts of money printing and monetary manipulation. So the only reason we really haven't had much of an inflation concern, we've been kind of tinkering around that 2% for a long time, is because the productivity gains have created a deflationary pressure, which has kept the ceiling on inflation really spiking. So I do think that's real. And that's my base case why I'm trying to position my family's wealth more in equities right now, is I think across the spectrum, as companies implement AI, become more productive, meaning they can service more clients with less cost because they don't have that as much of they can grow faster without adding human capital. I just want to ride on those coattails, right? And owning partial ownership of productive assets is the best, easiest way that I can think of to do that. But I would agree with that narrative that really what we've got to, what the Fed needs to understand is this a drawn out long conflict with elevated oil for a long period of time, meaning it's not the right time to cut? Or can we go back to the original table that was set at the beginning of the year, which is, hey, we're in this new AI, agentic AI, agent, Claude bot reality. Companies are not planning to necessarily slash, but they're going to increase their token cap spend and maybe not their labor spend. And then they're going to see those productivity gains. And we could cut into this kind of force. So I think if anything, the reaction that the markets had over the last 2 weeks has been a realization that they're not that concerned in the long run with this Iranian conflict. We'll see what tomorrow brings. But the fact that we hit all-time highs and roared back with the velocity that we had has to be that the market is pricing out the short-term headlines, which is the war, the conflict, and they're starting to look more at the fundamentals and where they see AI taking and carrying them.
Yeah, I mean, this is such an interesting concept. I've been beating the drum for a long time about, when we have these discussions about interest rates and, you know, whatever, cuts and the housing market and, inflation. I pretty consistently, I mean, we could go back in the archive of these episodes and we could listen for verification, but pretty consistently, my solution isn't some strategic rate cut, plan. It is how do we bolster GDP? And when I look at this AI, right, when I see the Fed considering, hey, we could possibly cut interest rates in the future, that is stemming from an increase in GDP production, right? AI is increasing US GDP. Now, the long term impact of that GDP production, I think the jury's out. Does that trickle down to the general population? I think there are going to be some symptomatic side effects that do, but is, this is kind of one of those unknowns where we're just in such new territories. Like, how do these, handful of corporations that have the piggy bank to really go all in on this AI right now and integrate this technology? And, let's say they do become more productive. How are they going to move forward in an ethical way? And will it impact the consumers at large? And then we can kind of get into more discussions that are down a rabbit hole of, well, what about universal income? And, is this going to eliminate jobs? Like, what are the side effects? I think that's a whole other episode and a whole other conversation. And quite frankly, I don't think anybody knows. And I'm honestly conflicted about it myself. I do think as we see, jobs being eliminated, there's one of two things are going to happen. Either it creates more jobs, just like any other, technological boom, or yeah, we're going to be looking at a situation of universal income, in which case I'm conflicted. I really don't love being in marriage to the government for income, but that again is a whole other conversation. I think when we just back up and look at why the Fed would be considering cutting rates based on productivity, really what they're saying is like, hey, we see this as increasing our national GDP as an industry leader, and therefore,
Well,
that's why they would make the potential cut.
I think they were predicting near double digit GDP growth this year, again, before the conflict,
Crazy.
which is
Yeah.
insane. That's like China kind of growth rate, right? US is typically like 1.5, 2%, pretty consistent. It's a massive economy. So to be cranking at 10% would allow for you can run the printer hot in those types of conditions. But I think when it comes to AI, the thing really where the trade that's been winning is in the utilities. And utilities are typically, it's like a defensive posturing for a portfolio because utilities are all weather, right? Whether it's a good economy or a bad economy, people want their AC on, they want their heat, they want the lights on, right? That's not something they're scrimping on for the most part. But with compute being tied to energy, right, and the demand of that compute going up so fast, there's been a lot of investment into infrastructure, and specifically that's falling into utilities, which I think is a good trend. But counter to that is there's a lot of states and a lot of projects to build these big data centers that are starting to cancel projects, which I think is a negative trend to us having this in the United States, which I think it's very dangerous if we want to offshore all of our large data centers, which will own this new sort of intelligence, right? I mean, if
Yeah, I
rare
agree.
earths is an issue, how is not having these agentic
Well, this is why we're
large
taking over
language
Greenland. You
models
didn't hear?
not be in the United States, right? Like we're going to literally, we can't have them in our backyard. So we're going to put them in neighboring countries. And if they just like, I don't know, seize them, that seems very risky to me. Like, why would we
It
do that?
does. Yeah. I mean, that's why we want Greenland, right? Put all the AI data
Or
centers, right?
and
It's
the
cold
moon.
there.
The
And the
moon.
moon.
That's what the moon's about. That's what Artemis is.
You bring up the moon in jest, but actually Elon is working on a plan to produce a lot of these data centers, this chip manufacturing in the vacuum of space. It has the tolerances that he's looking for. So we joke about it right now, but this
I'm
actually
not
could
even
be a
joking. I know they're actually making plans to do it, right?
no, they
So,
are. Absolutely. Yeah.
yeah.
They are. Let's move on to mortgage bonds and volatility, the housing signal here. So here's what matters for real estate. If you're listening and trying to glean some information on the real estate market, mortgage bond yields have peaked at 5.53% in March, and now they're around 5.11%, 5.11%. More importantly, the spreads widened in March, and we now have almost fully reversed. So why? Why is that? Well, volatility collapse. So the MOVE index surged, MOVE, and now back to February levels. So what does that mean? If we just do a simple layman's translation, that means that the bond market is stabilizing, and that's quietly bullish for housing. And I have seen evidence of that on the short term. What I would like to do though is I'd like to kind of throw this one back at you, and I want to ask you some questions on some of these events, Bromley. You always have such good insight. And I always love when I just put you on the spot and ask random questions. And so let's kind of go through start to finish. I wanted to talk about the bond market first, but maybe we'll go back
Well,
up to the
before you
top and we'll
ask me the
just
question,
yeah.
just in the most simplistic terms, not quoting, but where are you seeing roughly rates? Like what's possible with good credit right now?
VA, we're looking at 5.875% par. Well, this is all par, assuming a 700-ish credit score. Okay. I'm not
Mhm.
quoting interest rates. I'm just telling you what I've seen in the rate sheets in the market. So let's say you're a VA buyer, 5.875%. Par, no points. If you're conventional, you're probably closer to 6.25, 6.375. Par, no points. That's your free interest rate. FHA, you're probably 6.125%.
Okay, so
700
it,
credit
it had
score or
gone up
better.
to close to like 6.75, six
Oh,
point
yeah.
eight
Yeah, yeah,
three,
yeah.
and now it's back down to hovering around 6,
Yeah,
like
we've
we
made a
were
lot of
before the
ground.
conflict. Yeah.
If you're an investor and you don't want to have a global look at your credit or income, you want to purchase a investment property using what we call a DSCR, debt service coverage ratio, meaning it's just based on the investment property. DSCR is right now 6.375 to 6.5. So we've made back a lot of ground. We've definitely kind of come back. We shot up with the Strait of Hormuz and the Iran invasion, and now we're kind of coming back. Now, depending on what happens with the ceasefire, remember the market prices off of, emotion and sentiment. So if tomorrow Iran's like, deals off, war's back on, we're going to see the market make some huge moves. But what I guess is going to happen, if I have a crystal ball, is that that'll last a few days. We'll come to some sort of agreement again. We'll stabilize because the truth is that Iran needs that strait to be open, that peace to be, the global markets to be stabilized just as much as we do. We're kind of just playing this back and forth chicken game of who can hold longest before somebody gives. And we always find this neutral point back to this,
Yeah.
ceasefire. Like, okay, we have 10 days. Oh, we have 15 days. Oh, we have 5 days. Like, hang
My
on, hang on.
understanding
When
is
you're like, when you're wrestling your buddy on the playground and you're like, wait, time out, time out, time out. We keep doing these timeouts.
Yeah, yeah. My understanding is it started as a military conflict and then it's moved to an economic,
Yeah.
conflict. So basically the blockade's point is to starve the nation, which potentially could get the citizens of the nation to revolt against the government in the way that they're
Yeah.
acting. So who knows to if it'll work or not, but I'm generally don't love fighting. I'd love for Iran to concede to the United States will of dearming and not having access to nuclear weapons, and then we could allow the strait to open, clean it of many mines if they do exist, and get back to commerce.
Yeah. No, absolutely. All right, let me ask you a question about the bond market, and then we'll ask you a little bit about the global market and the global economy at large. I just want to see how you tick. I always take away something, just useful. And so let me ask you this. All right, so we've got mortgage bonds that are stabilizing. Volatility's coming down, but at the same time, oil could push inflation back up if this escalates, right?
Yeah.
So, how do you reconcile that as an investor? Do you trust what the bond market is signaling right now, or are you more cautious because of geopolitical overlay?
I mean, the bond market's the largest market. So if you notice now, a lot of people talk about poly markets, and when there's a lot of
Yeah,
money on
they're
the
just
line,
betting.
it's like, oh, this is probably more, this is, I have more confidence that this is going to take place because this scenario is winning out as a percentage and there's a lot of money in it. So the bond market is the ultimate sort of original OG largest poly market. So I would tend to trust the
Yeah,
bond
it's a good way to
market
look at it.
than I would the geopolitical news.
You know what? That is a good that's good insight. That's a good vantage point. You're right. Yeah, man. See, this is why I ask you these questions. Kind of reframes things for me sometimes. It's like I know that, but yeah, I need you to say it to remind me. Like, oh yeah, that's true. I didn't think of it like that.
Well, I just find poly market is really fascinating, right? Because it's, there are people that can spend a lot of time and analyze data and have an edge, and they can make money in this market. And, there's some studies, and I forget exactly what it was. I think I learned this at Berkeley, but it basically was some kind of phenomenon where if you asked enough humans, just pure randomness, right? You asked enough people, I want to figure out what this phenomenon is later. A random thing like, where did the ship that, I don't know, Cortez, if he had a ship that sank, where is it? If you asked enough people and then you averaged out the answer, you'd be pretty much spot on where it was.
Wow, are you serious?
Yeah, yeah, like, seriously. So to me, that's
Dude,
what the
that's
quality market
crazy.
is, which goes to say if there's more
No, you're right.
people with better information, get closer to the truth. And so anyway,
By the
I
way,
again,
low key flex right there. Yeah, I probably learned this when I went to Berkeley, by the way. That's where I went to school. Low key flex. All right. So, okay, from a wealth advisor standpoint, when you look at what's happening with the Strait of Hormuz, oil moving higher, geopolitical tensions rising, how are you thinking about risk right now across portfolios? Are you leaning more defensive? Are you guys still on the offensive, finding places to stay fully invested? Kind of like what's the strategy here right now? What are we seeing? What are we thinking about?
yeah, so I tend to I'm a little bit contrarian, I guess. Like when things are down, I'm more bullish. So like when the S&P was down 8%, I was getting more and more excited and kind of moving that direction. But as volatility spikes, I'm way more cognizant, and you entered or started the whole conversation on this fact of being diversified, because what you don't want to be is off sides. And when you're diversified, like you said, you've got polarity in the portfolio. So something you could be wrong, but something else is right. And so you're kind of juggling right and wrong on your way up, which, like you said, if you know 100% certain you're going to be right on something, then yeah, focus that energy, maximize your returns. But when it's an imperfect game and you're going to be wrong a lot, diversification is a winning strategy.
Yeah. I listen to the Tim Ferriss podcast a lot. I probably talk about it on this a lot as well. In fact, I know I do. But what makes Tim Ferriss interesting is he's an early angel investor, really big in the tech industry in the Bay Area, Silicon Valley, and he brings in the world's most successful, greatest angel investors. And it's always baffling to me how many bets they take and how small a percentage, how few actually make it. And what's crazy is like the amount of money that they're putting into each of these bets is astronomical, and they almost always go to zero. But there's like one or two that carries the rest of the portfolio. And I think about that. You don't really apply that same concept to the idea of diversification in your own, smaller portfolio, but it's the same. It really is the same concept when you think about it. It's like we're taking asymmetrical bets and we're spreading them out and hoping one balances the other. If one's down, one's up. We're not betting on five horses and five are, are winning for a tie. It's like one horse is going to win, but that one horse is going to pull the weight of the rest of the deficit and the loss. So yeah,
Although the way
good.
I think about that is a little bit different. To me, that's just it's a threshold for the risky money that you
Yeah,
have
yeah,
control of. So I would think of a pyramid similar to the food pyramid, if you will, where the base of the pyramid might be safe stuff like cash, good solid income portfolio, right? Maybe blue chip stocks, et cetera. And then as the pyramid narrows, you're taking with maybe 5 to 10% of your net worth, those types of asymmetric bets that you're talking about. And the reason you can take those bets is because you could lose them all. It's only 10% of your portfolio. You still have this solid base that's spitting off income. So, like, as you and I are building, right, we've got risky assets and we take big
yeah.
bets, but we're building it from a position of strength with a very strong foundation. And my whole thing, and I think we both share very humble beginnings. I've gotten this far. I don't want to start over again.
Yeah.
Right. So I always want to take an incremental bet where if I'm wrong, I'm back to still the best place I've ever been in my life. Right. And I
I
can
agree with
build
you.
from there. I'm
I
not
agree
trying to,
with you.
I don't
I
need to be a
wonder if
billionaire though
sometimes
either.
no, that's true. Yeah, no, listen, I'm betting the same as you're betting. But sometimes late at night when I'm laying in my bed, I'm wonder if that strategy is what's holding me back from the exponential growth that, we witness. And I don't know. I don't know. And also I don't really have the appetite to go see, you know what I mean? I'm happy building how I'm building, slow and steady. I have like a psychological safety net. And then it's kind of like I think of my investing as rock climbing is like I'll climb up, take risk, climb up, and then I stop. I set an anchor, I pull the rope up, I set my new high point, and I climb again. That way, if I fall, I'm only falling to here, not all the
Exactly.
way
Yeah.
back down to the bottom, So, anyways,
And I think that's a rational way to do it. And I don't think it's wrong. I also know that given enough time, we're going to get to where we want to be. Now, if you want to get there quick, that's where you take massive risk and you subject yourself to potentially starting over again. I mean, we know people that have filed bankruptcy, right? That were wildly successful. They're multimillionaires and now they're repairing their credit and trying to build and regain trust. And, that's just not a place that I ever want to be, quite frankly. Now, yeah, I am absolutely limiting myself to like a potential that I don't have yet. But I love Warren Buffett's quotes, right? Why risk money that we have why risk money that we have and need for money that we don't need? Right.
yeah, that's good. That is true.
And I botched the quote, but that's the gist of it.
No, yeah, great, dude. As always, this has been amazing. I think this was down and dirty to the point. We covered the highlights and the headlines. Can I just say one thing before we leave this week, Bromley?
Yes, please.
Okay. I publicly voted for Donald J. Trump. I voted for him all 3 times for President 45, the election he lost, and for 47. And I think that President Trump is potentially turning into President Biden. I think he has dementia. I don't really know what else to say. Did you see him post a picture of himself as Jesus? Did you see this?
No,
Oh, you missed this.
I
And
didn't see
then
that.
and then it got deleted and I can't make this up. He posted a picture of himself as Jesus and then there was like, of course, backlash and he deleted it and then came back and said, I thought it was a doctor. I thought it was a picture of me as a doctor. The internet is undefeated, by the way. The memes about being a doctor have been like unbelievably funny. He also was like raging about Iran opening the strait. He was like screaming and cursing the F word and he literally screamed in a tweet, Allah Akbar, happy Easter. I'm like, what is happening?
Whoa.
Is this Joe Biden? Did we go what's the chance that we get 2 back-to-back dementiaed presidents? Is that even what's the statistical possibility of that?
I don't know, but let's go check the poly market.
We should. Anyways, that's all. I don't
That's
know.
wild. I didn't see that. I gotta go look that up. Is that on
Yeah,
X?
dude. There's always feel like there's always something head scratching and unbelievable every time we do one of these. It's like, seriously? Seriously? Anyways, thanks, Bromley, man. This has been awesome. I look forward to seeing you in 2 weeks. As always, for all you out there, stay frosty on your journey to multi-millions and beyond. If you want to get in touch with me or Bromley, check the show notes below and we will personally be there to help you. Hope you guys do well. We'll catch you on the flip side. Peace.
Deuces.